Welcome back to Talk Tickers. If you're tuning in, you know the drill. We are not here for the corporate fluff. We're here to strip it all down to the raw numbers and figure out what is actually going on. Today, we're prying open the books on a classic American brand, Ethan Allen. They just dropped their fiscal 2026 Q2 results, and let me tell you, the market reaction was something else.
It was definitely a head scratcher.
Yeah.
A real disconnect. You see the headlines, flashing green with this nice earnings beat, but you look at the stock price, and it's just a sea of red, down nearly 7% on some pretty heavy volume.
Exactly. It feels like the market saw a good report card and, I don't know, decided to punish them for it. So our mission today is to figure out why. Is the market seeing something we're not, or is there a time bomb hidden in these numbers?
Well, if I had to sum it up, I'd use that old real estate analogy.
Yeah.
Ethan Allen is a really good house in a very, very bad neighborhood right now. I mean, management came out and they told this story of resilience, of amazing operational efficiency. And to be fair, the inside of that house is spotless.
But the neighborhood.
But investors looked out the window at the macro environment, at the neighborhood, and they just saw a storm rolling in. And they ran for the exits.
And investors hate storms. So, okay, let's start with the good house part. Let's hit the scoreboard, because on the surface, they did execute.
Well, they absolutely did.
Yeah.
If you just look at the bottom line, I mean, the profit engine is humming. Non-GAAP earnings per share, it came in at 44 cents.
And the street was at what, 38 cents?
38 cents, yeah. So that's a 6-cent beat. On a stock like this, that's significant. It's roughly a 15% beat.
Okay, so in a vacuum, a 15% earnings beat, that stock should pop.
In a vacuum, yes. They proved they can squeeze way more profit out of every dollar than anyone was expecting. They protected the bottom line.
But, we don't live in a vacuum. You actually have to sell things. Which brings us to the top line, the revenue.
And that right there is where the trouble starts. Net sales, they came in at $149.9 million.
Just under a 50, and the consensus was higher.
Yeah, the street was looking for over 152 million, so it's a miss. And maybe more importantly, it's a decline of 4.7% from last year. The business is shrinking.
So fewer dollars coming in the door? Okay, but wait. This is where the math gets weird for me. If your sales are down almost 5%, your efficiency should drop, right? But their gross margin actually went up. It hit 60.9%. That's up 60 basis points.
A record margin for them.
How? I mean, explain that to me. Like, I'm 5. If I'm running a lemonade stand and sell fewer cups, my profit per cup usually goes down because my fixed costs are the same.
You're talking about fixed cost absorption. It's Econ 101. In a manufacturing business, you have these huge fixed costs, right? The factory, the machines, the electricity. You pay those bills whether you make one sofa or 1,000.
The rent is due regardless.
Exactly. So normally when volume drops like it did for Ethan Allen, you're spreading those fixed costs over fewer sofas. So your sofa's cost goes up. That should crush your margin.
So by all laws of manufacturing physics, margin should have gone down?
It should have, but it went up. And that tells you they performed some serious financial gymnastics. They attacked the variable costs with everything they had. We're talking reducing headcount, optimizing logistics, being absolutely ruthless on waste.
Okay, so they cut the fat, maybe some muscle. But I have to play devil's advocate. You can't cut your way to growth. There's a floor, right? You can only pull those levers for so long.
And that is the exact fear that drove the sell-off. The market looked at that margin and said, bravo, that's amazing, but you can't do that trick forever.
If revenue keeps sliding, eventually that fixed cost burden just becomes too heavy. The market is betting that 60.9% margin is the peak, not the new normal.
Well, if we want to know if revenue is going to keep sliding, we have to look at the demand pipeline. And these leading indicators, scary is maybe an understatement.
It was ugly, yeah. There's no sugarcoating it.
Let's just run the numbers. Retail written orders down 17.9%.
Almost 18%.
Wholesale orders down 19.3%. And traffic to the design centers down 11%. When you see order drops approaching 20%, that's not a blip. That's a contraction. That is the customer just slamming their wallet shut.
No, management didn't just, shrug their shoulders. They had a very specific villain in this story. They blamed the government shutdown. So be honest. Is this just the dog ate my homework, or is there something real here?
In almost any other retail case, I'd say it's an excuse. But for Ethan Allen, it is actually a legitimate factor. We think of them as a mall brand, but they have a massive GSA contract. That's the General Services Administration. They furnish American embassies, federal offices, military bases all over the globe.
So they're basically the government's interior decorator.
Essentially, yeah. And government spending, it's binary. When the government shuts down, the purchase orders don't slow down, they stop. The procurement officers go home. The CEO, Farouk Kathwari, he was very clear on the call. He said orders for that segment went to zero.
To zero. So the lights went out in D.C. and the order book went dark.
Precisely. And because that's a big, lumpy part of their wholesale business, it just creates a massive hole in the data for the quarter.
Okay, but, and here's my pushback, the government's open again. Shouldn't we have seen a huge snapback the second it ended?
That's the nuance, right?
Yeah.
Management said orders are coming in every week now, but they also admitted they haven't gotten back to prior year levels yet. You have to remember, federal bureaucracy moves like molasses. Just because the lights are on doesn't mean the paperwork is caught up.
Okay, I'll grant them the GSA excuse. Makes sense. But it does not explain the retail orders. Mrs. Smith in Ohio buying a new sofa, she doesn't care about a GSA contract. Why are her orders down nearly 18%? You can't blame Congress for that.
You can't. And that is exactly why the stock tanked. It wasn't just the government. Management also cited, broad consumer confidence issues. The wholesale backlog dropped to under 50 million. It's a clear signal that regular people are hesitant to make big ticket purchases right now.
So a frozen government and a nervous consumer, that sounds like a recipe for disaster. But management tried to spin a bull case. They kept talking about a January bounce.
They did. They stated very clearly that they saw positive written order growth in January, which is the first month of their third quarter. Their story is that Q2 was a perfect storm, and now the clouds are starting to part.
Do you buy it? Or is that just, trust us, the check's in the mail?
I think it's a show-me situation.
Yeah.
Investors heard that, but they aren't going to pay for a January recovery until they actually see it in the Q3 numbers. Talk is cheap.
There was another move that I found really counterintuitive. Usually when sales are falling, the first thing you cut is marketing. You hunker down. But Ethan Allen increased marketing spend by over 25%. Why?
It's a high-stakes poker move. They're trying to force traffic into the funnel. They realized that just waiting for customers to walk in wasn't working, so they cut traditional stuff like print magazines, and they poured all that cash into digital.
So they're betting that if they can get a lead in front of a designer on Instagram, they can close the sale.
That's the bet. And this connects right back to that margin miracle we talked about. The only reason they can even afford to take this risk is because of their vertical integration.
Okay, let's dig into that buzzword. For a lot of companies, it's just a slide in a deck. But for them, it's the real deal.
It's the core of their entire model. About 75% of their stuff is made in their own North American workshops. They aren't just importing finished goods. Almost everything is custom made on order.
Which means they don't get stuck with tons of inventory if demand suddenly drops off.
Exactly. If orders drop 20%, they just buy 20% less wood, less fabric. They don't have to have fire sales. That protects the gross margin. It's also why they could cut their headcount by about 5%. They can just turn the dial on the factory floor much faster than a competitor who's waiting on a container ship from Asia.
Speaking of Asia, we have to talk about the other big headwind on the call. Tariffs.
Yes, and for good reason. It's getting messy. They're dealing with the new Section 232 tariffs. That's a 25% duty on upholstered wood products that started in October.
25% is a huge number. I mean, that can just wipe out your profit. What's getting hit?
It's specific stuff. Case goods from Indonesia, some black fabrics from Asia, lighting, rugs. Basically, the things they can't easily make themselves here.
So how do you fight that? You can't just eat a 25% cost increase.
They're pulling three levers. First is pricing. They pushed through a roughly 5% price increase in October, but it was surgical, only on the affected items.
Passing some of it to the customer?
Some of it.
Yeah.
Second, they're leaning hard on their vendors to share the pain. And third, they're looking to diversify their sourcing.
But there was a wild card, right? A potential legal windfall. I love a good wild card.
Ah, yes. The Supreme Court lottery ticket. There's a review happening right now of the AIA tariffs. It's a separate issue, but it affects about 40% of Ethan Allen's total tariff exposure.
And if the court rules against the tariffs, what's the upside?
If the Supreme Court strikes them down, management estimated it could save them about $8 million a year.
$8 million? On a company this size, that falls straight to the bottom line. That's massive.
It's huge. Now, management was very careful. They said, we are not banking on this. They're operating as if the tariffs are permanent. But for an investor, it's basically a free option.
So let's zoom out. We have record margins, a fortress balance sheet, $175 million in cash, zero debt, and this potential tariff windfall. But on the other side, plummeting orders and a shaky consumer, so why the big drop?
It all comes down to the fear of deleveraging. We talked about how well they absorb those fixed costs. But there's a breaking point. Even with their model, if your volume drops, say, 25 or 30%, you just can't cut enough costs. The factories become inefficient. The market is terrified. Q2 was just the beginning.
And I noticed something in the cash flow statement that really backs that up. Operating cash flow is negative 1.8 million. That's really rare for them.
Extremely rare. They're usually a cash machine. It was driven by working capital, lower customer deposits because fewer people were ordering. Seeing a negative number on operating cash flow, that's a big red flag for Wall Street.
So growth investors are fleeing, value investors are maybe hesitant. Who's left to buy this stock?
The patient investor, the one who wants that dividend. They declared 39 cents, so they're paying you to wait. It's a stock for people who believe the American consumer isn't dead, just taking a nap.
And for those who believe the government always pays its bills, eventually. Which brings us to our favorite segment. We've looked at the data, we've analyzed the sentiment. Now it's time for This Is Not Financial Advice. This is where we pitch a trade that's maybe a little wild, but plausible.
Let's hear it. What's the play?
I'm calling this one the bureaucratic backlog breakout.
Okay, I like it. What's the thesis?
The thesis is that the market has massively overpenalized the government shutdown impact. We all know how government budgets work, right? It's use it or lose it.
Absolutely true. If an agency doesn't spend its money, they get less next year.
Exactly. So the play is to go long ETD, specifically as a bet on government inefficiency. The shutdown didn't destroy demand, it just dammed it up. There is a huge backlog of furniture orders for embassies and offices just sitting on desks in Washington.
And when that dam breaks?
When the procurement officers finally clear that paperwork, it won't just be a return to normal. It's going to be a catch-up quarter. You could see Q3 or Q4 revenue estimates get absolutely blown out of the water as 6 months of spending gets crammed into 3.
So you're betting on a flood of purchase orders all hitting at once.
A flood. And here's the outrageous kicker. You combine that government order flood with a Supreme Court catalyst. If those two things happen around the same time, a huge revenue beat from the GSA and an $8 million cost savings from the court, you have a margin expansion story that would send this stock vertical.
That is, I have to admit, a pretty compelling narrative. You're betting on politicians to spend money and judges to cut taxes.
Two things they love to do.
Fair point. But as always, we have to remind everyone listening, this is highly speculative. You're betting on the whims of bureaucrats and judges. This is absolutely not financial advice.
Always do your own diligence. But it's fun to think about the upside, you know?
It is. But if we pull back to reality, I think the final summary today is this. Ethan Allen is running a very tight ship in a storm. They've proved they can still make money.
But you can't shrink your way to greatness.
Exactly. The next quarter is all about the top line. If that January momentum was real, the stock is cheap right now. If it wasn't, it could be a value trap.
So execution is high, but the macro is the deciding factor. We will be watching that order book like a hawk.
Absolutely.
That's a wrap for this deep dive into Ethan Allen's Q2. Thanks for listening to Talk Tickers. Remember to check the charts, do your homework, and we will catch you on the next earnings print.
Stay curious.